This presentation is for Chapter 2, Part 1, the balance sheet. The balance sheet is also called the Statement of Condition or Statement of Financial Position, and it provides information about the financial condition of the company at one particular point in time, usually the end of the month, quarter, or year. It summarizes what the company owns in terms of assets and what it owes to outsiders, either to creditors or as liabilities, or to the owners of the company as equity. This is the accounting equation that you are familiar with from Principles of Accounting. The left side of the equation is the total assets, and the right side is the sum of the liabilities and stockholders' equity. The balance sheet gets its name from the accounting equation, which remains in balance all the time. The assets must always equal the liabilities plus the stockholders' equity. This slide shows the consolidated balance sheet for Sage, Inc., a fictitious company that will be used throughout the textbook to illustrate the financial statements and analysis. The financial statements for Sage, Inc. are consolidated. Whenever a company owns 50% or more of the voting stock of a subsidiary, it must consolidate the financial statements of those subsidiaries with the parent's financial statements and present them together in one set. This is because the companies are in substance one company, given the proportion of control exercised by the parent. If the company does not own 100% of the voting stock, then the ownership of the minority or non-controlling interest in the assets and net income will be shown separately in the consolidated statements. The financial sheet is prepared at one particular date. Sage, Inc. uses a calendar year accounting period which ends on December 31st of each year. Years that end on other dates are called fiscal years. Financial statements can also be prepared at other times, such as the end of the month or quarter. Financial statements for only one accounting period would be of limited use to users because there would be no reference point for determining changes in a company's financial performance over time. Therefore, the SEC requires that companies present 2 years of audited balance sheets and 3 years of audited income statements and statements of cash flows. Neither the SEC, FASB, or IASB prescribe a particular format for the balance sheet, but most firms will prepare what is called a classified balance sheet. This means that the assets and liabilities are categorized into sections. Assets are generally classified into current assets, property, plant, and equipment, intangible assets, and other assets, while liabilities are classified into current and non-current. In the U.S., the assets listed are normally listed in order of liquidity, with the most liquid assets first. The liabilities are listed in order of maturity. It is important to note that foreign companies that use IFRS may order the assets and liabilities in a different order from U.S. companies. A very useful tool for analyzing the balance sheet is a common size balance sheet. Common size balance sheets are a form of vertical analysis that allows comparison of firms with different levels of sales or total assets by introducing a common denominator. A common size balance sheet will use total assets and total liabilities and stockholders' equity for the denominator, and then express the other components as a percentage of these amounts. This information helps to determine more easily the composition and changes in the composition of the balance sheet accounts over time and also in comparison to other companies in the same industry. This slide shows the common size balance sheet for Sage, Inc. based on the consolidated balance sheet shown previously. Note that the percentages are shown based on the total assets and total liabilities and stockholders' equity amounts, which are equal. Assets are segregated on a balance sheet according to how they are utilized. These are some of the most common categories shown on a classified balance sheet: current assets, property, plant, and equipment, and other assets. Current assets include cash or those assets expected to be converted into cash within 1 year or one operating cycle, whichever is longer. The designation current refers to the fact that these assets are continually used up and replenished in the ongoing operations of the business. The operating cycle is the time required to purchase or manufacture inventory, sell the product, and collect the cash. For most companies, the operating cycle is less than 1 year, but in some industries, such as tobacco and wine, it is longer. The term working capital or net working capital is used to designate the amount by which current assets exceed current liabilities. This is a list of the common types of current assets that you would find on most balance sheets. This slide shows Sage Inc.'s asset section for the consolidated balance sheets ending December 31st, 2016 and 2015. Two accounts, cash and cash equivalents, are generally combined on the balance sheet. The cash account includes both cash awaiting deposit or already deposited in the bank. Cash equivalents are short-term, highly liquid investments easily turned into cash with maturities of 3 months or less. Some examples of cash equivalents are money market funds, U.S. Treasury bills, and commercial paper, which are very short-term corporate unsecured debt. Marketable equity securities, also referred to as short-term investments, are highly liquid investments in debt and equity securities that can be readily converted into cash or mature in a year or less. Firms with excess cash that is not needed immediately in the business will often purchase marketable securities to earn a return. There are 3 categories of debt securities: held to maturity, trading, and available for sale, depending on how long the company wishes to hold the investments. If the company will hold the securities until they mature, they are classified as held to maturity. If they intend to sell them in the very near future, they are trading securities. Those that fall in between are classified as available for sale. The classification affects how the securities are valued and where the unrealized gains and losses are recorded. Both trading and available for sale securities are valued at fair value, and the unrealized gains and losses are reported in income for trading securities and in other comprehensive income for available for sale securities. Accounts receivable are customer balances outstanding on credit sales and are reported on the balance sheet at net realizable value. This means that the allowance for doubtful accounts is subtracted from the accounts receivable and the net amount reported. The allowance for doubtful accounts can be important for assessing earnings quality because it is an estimate of the amount of accounts receivable that management does not believe will be collected. The estimate should reflect the volume of credit sales, past experience with customers, customer base, credit policies, collection practices, and current economic conditions. This is an example of the calculation of the percentage of accounts receivable for Sage Inc., about 5%, that is not expected to be collected. There should be a consistent relationship between the rate of change or growth rates in sales, accounts receivable, and the allowance for doubtful accounts. If the amounts are changing at significantly different rates or in different directions, then the analyst should be alert to the potential for manipulation using the allowance account. This is an example of the growth rate calculations for Sage Inc. for net sales, accounts receivable, and the allowance for doubtful accounts. The net sales have grown by 40.9% from 2015 to 2016. The accounts receivable and the allowance for doubtful accounts have grown by 7.3% and 7.4% respectively over the same time period. To analyze the change in these 3 accounts, the analyst will ask these 3 questions. First, determine if the relationship between the 3 accounts are consistent in both direction and rates of change. Next, if the direction or rates are not consistent, try to determine the reason or reasons for the divergence. Last, if there is not a normal relationship in the growth rates, what are some possible reasons for that? For Sage Inc., all of the accounts have increased, but not at the same rate. Sales increased by 40.9%, but the accounts receivable and allowance accounts only increased by 7.3% and 7.4%. The next item is to determine possible explanations for any divergences in the trends. We need to explore why the sales have increased so much more than the accounts receivable. One possible explanation is that Sage has experienced a larger increase in cash sales than in credit sales. This is positive for Sage because cash sales do not have to be collected. Since both the accounts receivable and allowance accounts have increased at similar rates, we believe that management is not trying to manipulate earnings through the estimate of bad debts. The SEC requires some additional information in Form 10-K that can also be useful to analysts. This is the schedule of valuation and qualifying accounts. This schedule provides information on changes to the allowance for doubtful accounts. It reconciles the beginning and ending balances for the years represented and shows both the additions to cost and expenses and the deductions. This is an example of Sage Inc. Schedule 2, Valuation and Qualifying Accounts in Form 10-K for December 31, 2016, 2015, and 2014. The additions to cost and expenses are the estimates of the bad debt expense, and the deductions are write-offs of accounts receivable. An analyst would be able to use this information to determine if management is using the bad debts expense estimate to manipulate net income by underestimating the amount. If the amounts written off are much greater than or less than the additions, charges to cost, and expense, this would be of concern to the analyst in determining the quality of earnings. For Sage Inc., it appears that management is making a good estimate of the bad debt expense since it is fairly close to the actual amounts written off each year. Inventories are items held for sale or used in the manufacture of products that will be sold. It is one of the major revenue producers for most firms. Retail companies sell finished goods to consumers. Manufacturing companies purchase raw materials that they convert into work in process and eventually into finished goods. Service-oriented companies have little to no inventory. This diagram illustrates the typical percentages of inventory in relation to total assets for particular manufacturing, wholesale, and retail companies. Because inventories constitute a large percentage of most companies' total assets, the inventory costing method chosen to value inventory and determine the associated cost of goods sold has a considerable impact on a company's financial position and operating results. Understanding the fundamentals of inventory accounting and the effect of the various methods on a company's financial statements is very important to the user of financial statement information. The information on the inventory methods used and cost flow assumptions are disclosed in the notes to the financial statements. There are 3 inventory accounting methods that are used. They are first in, first out, or FIFO, last in, first out, LIFO, and average cost. Each of the methods will be illustrated to show how they are used to cost the ending inventory and determine cost of goods sold. This slide shows the information that will be used to illustrate the 3 inventory costing methods. This company is in its first year of operation. It has purchased 5 products at the amount shown. It sold 3 of the items and has 2 left at the end of the period. The cost flow assumptions for FIFO, LIFO, and the average method are illustrated. Under FIFO, items 4 and 5 are assumed still in ending inventory, and items 1, 2, and 3 are assumed sold. Under LIFO, items 2 and 1 are assumed still in ending inventory, and items 5, 4, and 3 are assumed sold. Under the average method, the cost of all of the units are divided by the total number purchased, 5, and the resulting cost per unit is multiplied by 2 to determine the cost for ending inventory and by 3 to determine the cost of goods sold. Using these cost flow assumptions, we see the calculated amounts for cost of goods sold and ending inventory under each of the three methods. LIFO assumes that the most recent purchases are sold first. During a period of inflation, LIFO produces the highest cost of goods sold and the lowest ending inventory of the three methods. This is considered to be the most conservative of the three methods during a period of rising prices. The inventory is considered undervalued on the balance sheet because the prices are older and therefore not the current replacement cost. FIFO assumes that the earliest purchases were sold and the remaining items in inventory are the most recent purchases. In a period of inflation, FIFO produces the lowest cost of goods sold and the highest ending inventory valuation of the three methods. The inventory is valued at current cost, but the cost of the goods sold is below the current or replacement cost. It is not considered to be conservative to use FIFO during a period of rapid inflation. This chart summarizes the three inventory costing methods for cost of goods sold on the income statement and ending inventory valuation on the balance sheet. Prepaid expenses are those expenses that the company is paid for in advance of their use and include items such as insurance, rent, property taxes, and utilities. They are part of current assets if they will expire or be used up within 1 year or the current operating cycle. They are generally not considered material to the balance sheet. The property, plant, and equipment account encompasses the company's fixed assets. These are assets that produce economic benefits for more than 1 year and are considered tangible because they have physical substance. Fixed assets are shown at book value on the balance sheet, which is cost minus accumulated depreciation. The proportion of fixed assets to total assets is largely determined based on the nature of the company's business. Manufacturing firms tend to be capital intensive, which means that they have higher percentages of fixed assets than wholesalers or retailers. Firms with newly purchased assets will have a higher proportion of fixed assets than firms with older assets because the newer assets have not been depreciated as long and also were purchased recently with normally higher costs than assets purchased long ago. Depreciation is the allocation of the cost of the asset over the time period that the asset will benefit the firm. There are different methods used to depreciate equipment. The depreciable cost is the original cost less the estimated residual value. This is the amount that is allocated by the depreciation method chosen. There are different depreciation methods. Straight-line depreciation allocates the same amount to each period of the asset's useful life. Accelerated methods apportion larger amounts to the earlier years of the asset's life, and the units of production method-based depreciation on actual use. To demonstrate the different depreciation methods, assume Sage Inc. constructed an artificial ski mountain in its Phoenix flagship store to demonstrate skis and allow potential customers the chance to test run skis on a simulated course. The cost of the mountain is $50,000 and it is expected to have a 5-year life and no salvage value at the end of that period. This slide illustrates the calculation of the straight line and accelerated depreciation for the ski mountain. The straight line depreciation per year is $10,000, calculated by dividing the $50,000 by 5 years. The accelerated depreciation using double declining balance multiplies the cost by 2 times the straight line rate, which is 20% per year. The accelerated depreciation for the first year is $50,000, which is 40%, or which is 50,000 times 40%, or $20,000. The ski mountain's net book values on the balance sheet for both the straight line and accelerated depreciation methods are shown, and the amounts of depreciation expense on the income statement for both methods are shown. This is the end of Chapter 2, Part 1, the balance sheet.